Welcome to the free life insurance training video provided by lifeinsurancetrainers.com. Today we're going to discuss annuities. Annuities, it's our product. It's in our wheelhouse. So many people are scared and coming into this business of what is an annuity. Well, we're going to break it down, and I think the easiest way to describe an annuity is to compare it to something most of us understand even coming into the business, which is a CD, certificate of deposit, with a bank. So with a CD, you're going to lock for 6 months up to 5 years. Now, typically, you're going to lock for a longer period of time to get a better interest rate, right? And that's not always the case. For our ease of discussion, let's just say the longer you lock, the higher the interest rate you're going to get. Otherwise, there's no reason to lock for a long period of time. Well, the annuity is the same way. You can have a 3-year, 4, 5, 6, 7, all the way up to 10, and maybe even beyond that. Most of the annuities I see are around the 7-year mark locked. So pretty simple, right? They're both locking vehicles. Now, a CD, your interest lock, the money they're going to pay you is locked until maturity. So if you elect a 1-year CD, then you're going to get 1-year locked interest rate that they're promising you. An annuity, you can have a locked interest rate for the entire 7 years. Or you can choose a 1-year lock with a floating interest rate annually. Why might you do that? Well, you're thinking, well, interest rates might go up, and I want to be able to take advantage of that. So I want my interest rate to float with interest rates each year after the lock. Now, a CD, the earnings of a CD would be taxed annually unless structured as an IRA. Now, I don't see a whole lot of them out there, but you can structure a CD as a retirement account. Then you would defer the taxes, of course. But typically, outside of an IRA, CDs would be taxed annually on the interest and the growth. An annuity, the growth, would be tax deferred. The government treats an annuity like an IRA, regardless of whether it's an IRA, in the fact that the growth of your money, so you put in $1,000 and you get a $70, $100 growth, whatever, that money is deferred until you either take the money out or you get to a certain age beyond retirement, typically around 70, 71 years old. So now you can structure an annuity like an IRA. You may say, well, Mark, if it's tax deferred, why do I need to structure it as IRA? Because you may want to deduct those annual savings of the premiums going in. But regardless, the growth in annuity is a tax-deferred vehicle until you access that money. Now, remember, there are some stipulations. Annuities can and will be penalized for withdrawing the money prior to age 59 and a half. So make sure you understand the ins and outs of an annuity and the surrender penalties. Those are important. Now, a CD, you would be penalized for accessing your funds early. Same thing with annuity. You could be penalized for accessing your funds early. However, most every annuity I've ever seen has a 10% withdrawal privilege each year. So if you have $100,000, you can draw out $10,000 each year. So there are strategies for accessing the funds early, maybe not all of it, but portions of it, whereas a CD, you can't touch that. So CDs are backed by the FDIC, and the annuities are backed by the insurance company. So, but please make sure you do not give tax advice. You leave that to a tax professional, and you should be, if you're discussing this, you should be a licensed annuity professional. Work with tax professionals to determine what strategy best fits your client's goals and needs.